Hello. In this video, we'll be going through expense-related deferred tax assets. For tax return purposes, when a company files a tax return, they have to calculate their taxable income and then and multiply by their enacted tax rate to get to tax payable. You would think that the income comes directly from the company's income statement that's reported on the 10K or that's just calculated for financial reporting. However, there are differences. There may be some differences between the revenue and expenses for financial reporting versus the revenue and expenses for tax. Some of those differences are temporary in nature, meaning that it's just a difference in when the revenue and expense is recorded on the tax return versus when it's recognized for financial reporting purposes. We have deferred tax liabilities, which are recognized when activities means revenue or expenses, are reported in the current period's income statement, which means financial reporting, and will produce future taxable amounts. This means we record less revenue or more expenses for tax purposes than we do for books in the current period, but that means we're going to have to recognize those revenues or disallow those expenses in the future, resulting in future taxable amounts, so result in higher taxable income and tax payable in the future. On the opposite side, we have a deferred tax assets, which are recognized when revenue and expenses reported in the current period's income statement will produce future deductible amounts. So this means we have more revenue and less expenses for tax than we do for financial reporting, but that means in the future, we're going to have less revenue or more expenses for tax. And therefore, in the future, we'll have lower taxable income and lower tax payable. And when we record the deferred tax asset and deferred tax liability and the current tax payable, the account that makes that journal entry balance is going to go to income tax expense, which lands on your income statement. So the income tax expense is really a plug in the journal entry when you record the tax payable and the changes in the deferred tax assets and liabilities. And we use a 4-step process to do this for income tax accounting. Step 1 is always calculate the income tax payable. This means the current tax payable. This is the amount of tax currently payable based on your current year tax return. So you look at your taxable income, multiply by your enacted tax rate. That's going to be your current tax payable, and that's a liability. Step 2 is you're going to calculate your ending deferred tax asset and deferred tax liability. And then step 3 is you're going to take the change between your beginning and ending deferred tax asset or deferred tax liabilities, and you're going to record that change as a debit or credit, depending which way it goes. And then the final step, step 4, is now you've recorded your taxes payable, you've recorded your deferred tax asset or liabilities. So step 4 is going to be you have to plug that journal entry to income tax expense. I've said this before, I'll say it again. When we have changes in deferred tax assets and liabilities, usually the journal entry should go to income tax expense. There are circumstances where they might not, but for an intro to accounting, to income tax accounting, within intermediate accounting, this is what we're going to assume, that always goes to income tax expense. Now, the temporary differences, as I said before, are one kind of difference for tax return purposes where the revenue and expenses get recognized at different times between financial reporting and tax. But at the end of the day, they will be equal. It's just a different periods. And there's 4 different types of temporary differences, and we have a video dedicated to each one of these. So let's get into it. And let's get into one of those temporary differences, are expense-related deferred tax assets. This means that we have something that is expensed for GAAP, which means financial reporting now. However, we do not get to take that expense as a deduction on the tax return until later. And usually later means when that expense is actually paid out. So meaning that in the future, we're going to have some sort of deduction on our return. So we have a future deductible amount, and we are going to record an asset called a deferred tax asset for that. Let's go through a couple of examples of expense-related deferred tax assets. Warranty liability. So let's look at the journal entry. The journal entry for warranty liability would be debit warranty expense, let's call it $1,000, and we would credit warranty liability for $1,000. Well, this expense gets recorded on the income statement and so is expensed on the financial reporting for financial reporting purposes. But for tax, I've said this before, that for tax purposes, tax is more like a hybrid between the accrual basis and the cash basis. And specifically for warranty expense, it's more like the cash basis. So you don't get a deduction for any of the warranty payments until they're actually paid. So this expense will be added back into the taxable income. And when that warranty expense is actually paid out, that's when that deduction will happen. Same thing with litigation accrual, right? We would debit some sort of legal expense and credit a litigation liability for some amount. And so that expense goes on the financial income statement, but for tax, it doesn't get deducted until it's actually paid. And then bad debt expense is also similar, right? We have an allowance for doubtful accounts that we record for GAAP, but for tax, we only get it using the direct write-off method, which means when we actually know that we will not be collecting that accounts receivable, then we can deduct that on the tax return. Let's go through an example. RDP Networking reported pre-tax accounting income in 2027, 2028, and 2029 of $120 million, $100 million, and $100 million respectively. The 2027 income statement includes an $80 million warranty expense that is deducted for tax when paid, which is $36 million in 2028 and $44 million in 2029, and the income tax rate is 25% each year. Let's just look to see how they come up with the pre-tax accounting income in this problem. We're told for each of the years, starting with 2027, it's 120 million, 100 million, and then another 100 million. So I just backed into the income before warranty expense. So for 2027, we started with income of 200 million, and then we had warranty expense for 80 million to get us to our pre-tax accounting income of 120 million. And then for 2028 and 2029, there was no warranty expense recorded, so the income before warranty expense and after warranty expense is the same, and there are 100 million in each of those years. This is when $36 million and $44 million was paid in those years. But that's not being taken as an expense for financial reporting because the full 80 million was already expensed in 2027. So when we look at what happens for tax purposes, let's start with 2027. We start out with our pre-tax accounting income, and that just means that pre-tax income on the financial statements on the income statement that you see in the 10K. And that's $120 million, which this number, as you saw in the previous slide, includes the $80 million expense in there, right? So for tax purposes, we're going to add back that expense because we only take that deduction when it's actually paid. And so our taxable income for 2027 is $200 million. You'll see that it's higher for accounting purposes. The pre-tax income is 120 and the taxable income is higher by 200. But in 2028, we're going to be able to take that deduction for the warranty that was paid for $36 million. So we're going to start with pre-tax accounting income of $100 million minus $36 million. So our taxable income in that year is $64 million. And in 2029, pre-tax was $100 million. Warranty payments were $44 million. So our taxable income is $56 million. So just want to kind of point out that if you look at right here on the very right hand side, the warranty expense for book purposes or financial reporting, they took $80 million of warranty expense, and $80 million of warranty deductions was taken for tax return purposes. It's just a matter of different timing, right? 2027 for books versus 2028 and 2029 for tax purposes. So this results in a temporary item for which we will get a future deduction. When we add this 80 million, we will get these future deductions in the next 2 years. So let's go through and look to see how we record everything on our books. So we'll start with 2027. We had pre-tax accounting income of 120, disallowed that warranty expense by adding it back. So we have taxable income of 200,000, and our enacted tax rate is 25%. Plus, then we also know that we're going to get these future deductions in 2028 and 2029 for $36 million and $44 million respectively, which totals $80 million. And then at 25, and then we have to tax affect that. But when we go back to our 4-step process, step 1 is calculate the current income tax payable, which is what is due on your current year tax return. So we're going to take our taxable income times 25%, and that gives us $50. So we're going to credit income tax payable for $50 million. Step 2 is calculate your ending deferred tax asset balance, which is for us our $80 million at 25% gives us a deferred tax asset balance of $20 million. And this is going to be an asset because it's a future deduction, right? It's a future deductible amount that we know about. And then step 3 is take the change between the beginning balance of your deferred tax asset and the ending balance. Our beginning balance was 0, ending is 20. So we're going to debit deferred tax asset. And then step 4 is recording our plug to income tax expense to make the journal entry balance, which in our situation is it would be a debit to income tax expense for $30. Let's go on to 2028, see what happens there. We start with our pre-tax accounting income of $100, $100 million. We take our deduction for the warranty payments for $36 million. So our taxable income is $64 million times our 25% tax rate gives us our current income tax payable of $16 million. Again, this is what we owe when you look at the corporate tax return for that year. So we're going to credit income tax payable for $16. Step 2 is determining our ending deferred tax asset. And if you recall, deferred taxes are always what happens in the future. It does not include what happens in the current year. So when we look at what are our future deductible amounts, we only are looking at the 2029 year because the 2028 year, right, we've already accounted for it in our current income taxes payable. So in the future, we'll have a $44 million deduction at 25%. Our ending deferred tax asset should be $11. And to make that happen, we would have to credit deferred tax asset for $9. And then step 4 is our final step, and it's the plug to income tax expense to make the journal entry balance, which would be a debit of $25. Let's go to our final year of 2029. We start with our pre-tax accounting income of $100 million. We made warranty payments of $44 million, so our taxable income is $56 million at 25%. That gives us our current income tax payable of $14 million. So we're going to credit income tax payable $14 million. Step 2 is to calculate our ending deferred taxes, our ending deferred tax asset in this situation. and we have no more. We are all paid out for this particular item, so our ending deferred tax asset will be 0. So step 3 is take the change in your balance between 2028, which our beginning balance was 11 million, 2029, our ending balance was 0. We need to credit deferred tax asset to make that happen. So that's what we book. And then step 4 will again be the final plug, income tax expense, debit $25 million. This is an overview of the deferred tax asset and what happened to it from a T account perspective. We started out with 0. Then we recorded a $20 million deferred tax asset because we added back that $80 million warranty expense in 2027, knowing that we would get that deduction in the future. And we did get that deduction, so we had to reduce our deferred taxes in 2028 and 2029. And then after those 2 years, our balance in our deferred tax asset ended up being 0. Let's do a concept check. Dutchess Company started the period with a deferred tax asset of $400. As of the end of the period, Dutchess identifies future deductible amounts, so that means we know it's a deferred tax asset, of $1,120. Dutchess has a tax rate of 25% and calculates that taxes payable will be $200. Dutchess's tax expense journal entry would include a what? Always make sure to look at your question to see what is it asking you. In this situation, it's asking you for your income tax expense. So let's take this step by step. First, we're told that they started with a deferred tax asset of $400. So we're going to do our T account and have a beginning balance of $400. Then we're told that Dutchess identifies future deductible amounts of $1,120. So that's going to be our ending amount in our deferred tax asset account. So we're going to take the $1,120 multiplied by the enacted tax rate, which is 25%, which gives us an ending balance of $280. And the difference is $120. So we would have to credit deferred tax asset for $120 to make that happen. So that's one part of our journal entry. Our other part of the journal entry is that it also tells us that the taxes payable is $200. So we're going to credit taxes payable $200. We have a credit to deferred tax asset of $120, which means that our debit has to be, that would be our step 4. The plug goes to income tax expense to make a balance, which will be a debit of $320. So your answer is C.